Hey everyone, this is Rob Keens with goldsilverpros.com. It's Friday, March 5th, 2021. Hope you guys have had an awesome week and are going to have an even better weekend. I want to put out this special alert today because there is a crisis again in the repo market, and I wanted to talk to you about what's going on with it. I think this could be major in terms of the solvency of the system moving forward, especially in light of the new Basel requirements for liquidity. But also appears as though the bond market and the repo market may be preparing for another meltdown. And if it does, this is going to be very, very big. This could be the black swan that we're talking about, what crashes the financial system. So we need to take a look at it. And I'm going to, in addition, in this video, look back to what happened to the repo market in 2019 and in 2008, because yes, what led off the mortgage crisis 2008 was the repo market, according to the National Bureau of Economic Research. So we're going to get into all of that. Stay tuned for all of that in this video. Let's go straight to the share screen and we will get to what we're seeing. First thing I wanted to cover is the increase in the overall bond market. I just have a chart here, the 10-year US 10-year Treasury from CNBC, and you can see that rates have spiked since August. Of course, we had several months of shutdown dating from March to about August, and then the rates started to rise. Increasing, you could do a little bit of an increasing parabola effect here if I was using a draw tool here to illustrate the fact that this is increasingly going up, and especially since January this year. So after the first month of 2021, it's really started to spike. It's gone from 1 to about 1.57. As the yield rates spike on the 10-year, that means things are going to get more expensive. You're going to have more expensive mortgages. It's going to be more expensive for the US government to service all these treasuries, and anything based upon these 10-year rates is going to get more expensive. We'll talk about that a little bit later. Here's the stunning thing, and I'm going to use a lot of Zero Hedge articles because they were on it, and this is one of the things that Zero Hedge covers the best is the bond sector. If nothing else at Zero Hedge, come here for the bond coverage. The 10-year Treasury hits a stunning negative 4.25% in repo as yields blow out. So what is the repo market? Is the overnight lending market in which businesses get access to cash and short-term liquid investments for purposes of financing their business. It's kind of one of the wheels in the system that one of the important wheels in the system that if it stops moving, you have major issues that are going to cascade throughout the rest of the clockworks and the mechanics of the system, and it could end up crashing it. And again, I'll show you in 2008, where according to the National Bureau of Economic Research, what really kicked off the last financial crisis was problems in the repo market. So this is worth paying attention to. This is a major indicator of problems in the banking system, cannot be ignored. Okay, so first thing you're asking is how can you have a negative 4.25% in an overnight lending rate? That means you basically have to pay to lend out money to other people or to lend out treasuries to other people. It doesn't make a lot of intuitive sense, but it happened. So I'm basically going to read a little bit from the Zero Hedge article, then we're going to move to some charts and things. I'm going to kind of show you and illustrate what this means. It's kind of a complex topic, but definitely worth you paying attention to. So as we start here, Zero Hedge says, last night we first pointed out something shocking, and I'll get to this article here in a minute. I'm going to go through the second article in this series at Zero Hedge first, and then go to the first one. As a result of the massive wave of shorting in treasuries the past 3 days. So people are shorting treasuries. Why do you short treasuries? Well, why do you think? You don't think they have the value, you think they're going to fall. The 10-year Treasury hit a record negative 4% in repo, an extremely rare event, and one which occurs only when there is a dramatic shortage of collateral as a result of over shorting. Think of it as very hard to borrow condition for stocks. You get to the point you shorted so much, you can short no more, and that creates a dramatic shortage of capital. Again, what happens when the repo market locks up and there's not enough capital to keep those businesses running? Then you have economic lockup in the system. What was even more amazing is that the repo rate was below the fails charge, which at least in theory is the absolute minimum that a 10-year rate can hit in repo. Effectively, it meant that an investor in the repo market lending money so others could short the 10-year ends up paying rather than getting paid. Needless to say, this is a clear breach of one of the most fundamental relationships in the repo market, where lenders of cash always get paid, however little, in order to make a more liquid and efficient market. Okay. So it's more amazing that it's below, and that it's those lending money end up paying rather than getting paid. So you're lending, you expect something in return for getting the asset back plus some rate of interest. That's how normal markets work. The opposite. You had to pay to lend. That's an overshorted market. And this led to Bloomberg to issue the following comment. 10-year trade special in repo as selling drives demand. So many investors are short 10-year treasuries that there aren't enough to go around, in bold. As a result, the rate to borrow 10 in the repo market reached as low as -4% on Tuesday and is printed around -3.95% this morning. An investor lending out cash for the 10-year bonds would end up having to pay rather than getting paid. That's below the -3% charge leveled on users who failed to deliver a security to a counterparty. So if you completely fail to deliver and you screw up the whole thing, it's only a -3% charge. The actual repo rate went below the fails charge, meaning it's worse than somebody not holding up their end of the bargain. That's how bad it is. And theoretically, it shouldn't be possible, but it just happened. Besides the massive short base, as discussed by his colleague Stephen Spratt, the Federal Reserve is taking supply out of the market through its asset purchase program. Remember, the Fed is buying the Treasury's debt, direct monetization of the debt. That's what they're talking about here. The New York Fed owns roughly $14.9 billion of the 10-year that was sold in February. Demand is so great that dealers have borrowed almost all of it from the central bank, according to the New York Fed data. Okay, and with everyone, I'm going to read this sentence and then go on to show you where something didn't happen that they thought would happen when they printed the article. And with everyone suddenly obsessing with both the SLR and the repo malfunction, that's why we said that during today's Wall Street Journal video conference event, Fed Chairman Powell has to address the ongoing crunch in the repo market and the fade the SLR extension. He didn't. He failed to address it. This came out in a subsequent story. The market doesn't know what to do. Powell never got to that question today. Either he didn't want to answer it, he wasn't prepared to answer it. Here's the overnight rates. Here's the history of overnight rates dating back to 18. And here's another one dating back to 16. Look at this candlestick dipping down below 4%. That's amazing. As Treasury yields are going up. What does this mean? Well, there is a shorting of the bond market and a sell-off. And the sell-off right now is -27.7%. It's second only to the taper tantrum, which is another period of time after the financial crisis we won't worry about. But there's huge sell-off in the bonds. In other words, people don't believe in the bond. It's a crisis of confidence in the bond. And there's massive shorting, and that's affected the liquidity that underlies the system. One of the liquid, basically oil in the engine. All right. Remember what I talked about in a previous video where I said everything's sort of tightening up and the liquid's draining out of the engine. This is happening in the repo market because of the bond weakness. So you have, let's recap, you have raising bond rates, which makes it more expensive to borrow money or to pay off interest on bonds or to release new bonds, because if yields go up, then that means you have to pay more for each subsequent new release. So it makes it more expensive for the government to borrow. It makes it more expensive for people to borrow for mortgages. That's why I said we're never going back down to the ultra cheap mortgage rates. We've reached the bottom, at least for the next 5 to 10 years. Mortgage rates are going to do nothing but rise. You're going to see this happen. So it's going to get more expensive to borrow. Here's the first article in the series. I get to the first article second to get more into the details. So they say here, something crazy happened in the repo market today, according to curvature repo guru Scott Skirm. The 10-year traded as low as -4%, a record low level, an unprecedented dislocation for the world's most liquid security, one with potentially tremendous consequences for what Jerome Powell may say tomorrow. Of course, we found out he didn't say anything. And what Skirm said, the expert said, was it's all over for the 10-year note. That's in bold. It's all over for the 10-year note, the most liquid note in the world. Dramatic, but this is the expert talking. Clearly, a significant amount of shorts rolled forward, and now short demand has overwhelmed the available supply. The issue traded as low as -4% today and already traded at -3% for tomorrow. Both of these rates are lower than failed charge. Both of these rates are lower than if the system just fails and one of the parties fails to deliver. So here it is. Here's the 10-year overnight rates. This is where it was before, and then boom, just falls through the floor. Something very interesting in this article, and the reason I wanted to do this article second, was information from Goldman Sachs, Bloomberg, on the liquidity of bonds, the US Treasuries and the bonds. Look how low it is. There's not enough liquidity in the system. It's affecting the repo market. It's affecting a lot of things. Liquidity has fallen down. I'm going to show you where I predicted something like this would happen all the way back in 2018 in an interview I did with Lynette Sang. Although I didn't use the term repo market, I basically called this whole mechanics of the system that started September 2019 when it had the last repo crisis and now is happening again in March of 2021. It's not stopping about a year and a half later. In other words, the Fed didn't solve the problem a year and a half ago when they started injecting liquidity in the repo market. It was temporary. It's happening again. Meanwhile, none other than Fed Vice Chair Lael Brainard, who is until very recently expected to become the next Treasury Secretary and is widely considered to be Powell's replacement as Fed Chair. Okay, so very important guy. Said on Tuesday, the Fed is now paying attention. Well, thank God the Fed has decided to pay attention to this potential seize up in the bond market and the repo market. I'm paying close attention to market developments. Some of these moves last week and the speed of those moves caught my eye. I would be concerned if I saw disorderly conditions or persistent tightening in financial conditions that could slow progress toward our goal. And here's Posar, somebody that writes for the Global Money Dispatch, said the following, and I agree with him. For every macro narrative that explains why US Treasury yields are rising, there's also a plumbing narrative that can explain things with equal persuasion. So I talk a lot about the macro, the problems in the economy, but the plumbing, the repo market is starting to suffer because, and I'll show you in a minute why that's going to occur. So going to the Brookings Institution, what is the repo market and why does it matter? There's some really good explanatory things in here to explain what it is if you guys are not super familiar with the repo market. First things first, what is a repo market? A repurchase agreement, or repo, is a short-term secured loan. One party sells securities to another person and agrees to repurchase those later at a higher price or with an interest rate. The securities serve as collateral to that loan. The difference between the security's initial price and the repurchase price later on is the interest paid on the loan, known as a repo rate. There's a reverse repo. We want to talk about that. The repo market is important for two reasons. The repo market allows financial institutions that owns lots of securities, like the banks, broker-dealers, hedge funds, to borrow cheaply and allows parties with lots of spare cash to earn a small return on that cash without a lot of risk. Because the securities, often US Treasuries, serve as collateral. They're considered risk-free, but they're not. We'll see that here in a moment. Financial institutions do not want to hold cash because it's expensive. It doesn't pay interest. Okay. For example, hedge funds hold a lot of assets, but may need money to finance day-to-day trade. So they borrow from money market funds with lots of cash, which can earn a return off taking much risk. Second reason why repo is important. The Federal Reserve, the central bank of the United States, the largest and most important of the central banks, uses repos and reverse repos to conduct monetary policy. They're in that market. Earlier, when we said that the Fed is buying some of the debt issuance, that's what they're talking about here. When the Fed buys securities from a seller who agrees to repurchase them, it's injecting reserves in the financial system. Conversely, when the Fed sells securities with an agreement to repurchase, it's draining from the system. Since the crisis, reverse repos have now taken on a new importance as a monetary policy tool. Reserves are the amount cash banks hold, either currency in their vaults or deposit at the Fed. The Fed sets a minimum level of reserves. Anything over the minimum is called excess. Okay. That's key because remember, Basel coming up is going to put additional upward pressure on liquidity ratios. You have to have more reserves. Okay. Right now, we're seeing with the issues in the repo market, banks don't have enough reserves. What was the problem in September 2019 when the repo market seized up? They didn't have enough reserves. What was the problem in the financial crisis of 2008? They didn't have enough reserves. Well, here you have even more standards being enacted across the world at a time in which they don't have enough reserves. Do we see a problem there? All right, now this talks about what happened in September 2019. I want to show this to you because I was on the air talking about this, and it's very, very important. Because remember, the repo rate was the first bad thing that happened that led to the mortgage crisis in 2008, and it happened again in 2019, and it's happening again now. The repo rate spiked in mid-September 2019, rising to as high as 10%. See here. Intraday, and even then, financial institutions with excess cash refused to lend. Okay, why? Because they see risk in the system. Banks will stop lending when they see risk. That's why the rate will spike. The spike was unusual because repo rate typically trades in line with the Federal Reserve's benchmark federal funds rate, in which the banks lend reserves to each other overnight. So the repo market generally follows the bank-to-bank lending market, but it didn't in September 2019. Two events coincided in September 19 to increase the demand for cash. Quarterly corporate taxes were due, and it was settlement date for auction Treasury securities, but that's not all. That didn't explain all of it. There was a lack of general security in the system, or general liquidity in the system. Something key here. Prior to the global financial crisis, the Fed operated with what's known as scarce reserves framework. Banks tried to hold just the minimum amount of reserves, borrowing the federal funds market when they were a bit short and lending when they had a bit extra. Fed targeted interest rate in this market and added or drained reserves when it wanted to. So that was prior to the global financial crisis. That's what caused the repo crisis in 2008. There wasn't enough. There were scarce reserves. They were holding the bare minimum, and they miscalculated. The system miscalculated, and it started to seize. Okay. So then they switched over to quantitative easing and excess reserves. So now you have excess reserves, and they measure it. Source according to Fred, the Brookings Institution measures it. How much excess reserves? And the Fed says, well, as long as we have 1.2 trillion excess reserves, we're okay. Except in September 19th, they miscalculated. Twice, the Fed has miscalculated. 2008, the repo crisis, when they were using scarce or just a little bit of reserves, and then they upped it to 1.2 trillion minimum, but that wasn't enough because in September 2019, it seized again. So here's the trend that you need to be aware of. Even though the bank's reserves have been increasing, we keep hitting the same problem, okay? So even though Basel III is going to come into effect and it's going to raise those reserve requirements and those liquidity ratio requirements, it may not be enough. Why? Why over time would you need more and more levels of reserves, but you still keep hitting the same problem? Or put another way, you have to increase the money in the system to keep it from crashing, because that's the nature of the Keynesian debt-based system. We're at the end stages where they keep having to flood the system and it's not enough. And they do it again and it's not enough. Okay. And the Fed has no control because they've been wrong twice. They were wrong in 2008, the global financial crisis. They were wrong when the economy almost crashed in September 2019, the last repo crisis. Okay. They've been wrong twice. What says they're going to be right this time? That's why Powell did not address it in the Wall Street Journal interview or presentation. He doesn't know. Okay, he doesn't know. But the Fed doesn't know for sure the minimum level of reserves are, according to Brookings. And surveys over the past year suggested reserves wouldn't grow scarce until they fell to 1.2 trillion. The Fed miscalculated in part based on the bank's response to Fed surveys. So back in September 2019, 1.2 trillion was not enough. And that's a lot. 1.2 trillion is nothing to sneeze at. Fed officials concluded the dysfunction in the very short-term lending markets may have resulted from allowing its balance sheet to shrink too much. In other words, they can't stop QE. They can't stop it. They can't stop the system. If they tighten up, it crashes, even with 1.2 trillion in reserves. So that's why they have to keep printing. When I say they have to keep printing, I'm not the only one. This is a financial analysis of why exactly that occurs. Because they tried to go to this excess reserve model and they still screwed it up because their formulas don't work. Because as you age in this fiat debt system, everything has to grow more until it blows up all over the place. Okay. And how close were we the other day? Okay. When the repo market rates dropped below the fail rate of 3%, went to -4%. How close are we to the repo market seizing up again? And this time is partially caused by a lack of faith in the bonds. Why? Because they're being shorted. Remember. They're being shorted here. Look at this, almost at a record level. That's why the rates went down so much. And that's causing a seize in the repo market. Okay. The actual quality of the treasuries, if people don't believe in them, can cause a seize up in the market in which you lend those treasuries. It's common sense. And that's where we are. People have figured the jig's up on the 10-year Treasury, the 10-year bond. They don't believe in it anymore. The market doesn't believe in it, and that is a major problem for the fiat money system in the Fed. All right, so we're going on to the Fed's explanation. One chart I wanted to show you in the Fed's explanation. This is on federalreserve.gov, what happened in the money market September 2019. This is printed February of last year. And they talk about all this stuff, but they're talking about the SOFR. Look at the SOFR spike here. Okay, repo market SOFR spike. Remember when I talked earlier this year about changing from LIBOR as a determinant of interest rates to changing to SOFR as a determinant of interest rates? When SOFR goes up like this, does that tell you that that is a stable measure? This is a stable measure, the Fed funds target range. This is not a stable measure. This is volatile. So the Fed's own admission that the system we're going to determine rates, when we move off of LIBOR and on in the US to SOFR, it's volatile. It's unpredictable. We don't know what's going to happen. And I said that in my video. I said you're going to have more volatility in the financial system because of the way they determine interest rates is basically a derivative of SOFR. And if you want to know what SOFR is, I go in detail over that past video. I'll try to link it down in the description. If I don't, call me on it and I'll put it down there for you guys. Go watch that video. I talked about SOFR back then. It's an important component to understand in the calculation of interest rates. It's going to make it next to impossible for the Fed or anybody else to understand true risk in the system and true volatility. And now it's starting to show because it's related to the repo crisis. Okay, that rate spiked during the repo crisis. Key. This is how all of this comes together. Now, there's an interesting article here at Forbes talking about the real story of the repo market meltdown and what it means for Bitcoin. Now, I'm not going to get into the Bitcoin piece. I want to focus on the repo market piece. But this is right after the repo market started to seize back in 2019. It says, last week, the financial system ran out of cash. Yeah, we covered that back then. At a systemic level, the traditional financial system is as fragile as Bitcoin is anti-fragile. Now, I don't agree that Bitcoin is anti-fragile, but who cares? Okay, listen to this lady at Forbes, what she says about the repo market crash in 2019. Okay, that applies today even more because the system gets more fragile as we go, as you blow up and do too much quantitative easing and monetary expansion. Last week, the financial system ran out of cash. Just remember, back in September 2019. It's a modern version of a bank run, and it's not over yet. Stepping back, it reveals two big things about financial markets. First, U.S. Treasuries are not truly risk-free assets. Ding, 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 ding. Why is there a bond sell-off? Because people realize that they're not risk-free assets. The public gets it. And it's funny that the person at Forbes is talking about this, and we have the problem 18 months later because now the entire market understands this. Getting back. U.S. Treasury are not truly risk-free assets, and most consider them to be, and second big banks are significantly undercapitalized. What I've been talking about, liquidity ratios, okay? And Basel III, undercapitalization. The banks are still undercapitalized. Basel III is going to try to rectify that. The problem is, where are they going to get all the capital? Where are they going to get it? They don't have it now. You think in 6 months they're going to have it or a year they're going to have it? No, I don't think so. The Fed can pump all the money they want in the system, but all that does in a debt-based system is also blows up the debt. Okay, that's key. And the debt gets blown up faster than the cash. So we're at the point at which it's got a negative rate of return, or return on income, or whatever measure you want. In other words, the more that we do, the worse it gets at this point. That's where we are essentially. What's happening in plain English? Somebody, probably a big bank, needs cash so badly it's been willing to pay a shockingly high cost to obtain it. That's the layman's explanation of what's happening. Interest rates have betrayed common sense. Interest rates in the repo market should be lower than rates in unsecured markets because they're trading treasuries and they're overnight. So it's short term and it should be very liquid. So should be, but not, as we see the rate issues, because repos are secured by assets and less supposedly lower risk. But repo rates spiked way above unsecured lending rates last week, even for risk-free collateral such as U.S. Treasuries. But U.S. Treasuries are not risk-free, far from it. By this, I'm not referring to you as potentially defaulting. Rather, I'm referring to the practice of repo market that allows most people to believe they own U.S. Treasuries, more U.S. Treasuries than they actually do. It's called rehypothecation. So this is one of the big bombshells I'm going to talk to you about today. Most treasuries are held by more than one person. Generally, that's called fraud, but they're calling it rehypothecation here. And I want to get to it. Here we go. The elephant in the room, she says, back in 2019. Almost no one was talking about this back then. The fact that there's a derivative complex on top of US Treasuries and why it's the US Treasury itself, because of this, is not so risk-free. And we're not even talking default risk. She's just talking about rehypothecation, or basically what I call fraud or derivative, whatever you want to call it. Derivative to me equals fraud. Derivative equals fraud. Here she says, for every US Treasury security outstanding, roughly 3 parties believe they own it. That's right. Multiple parties report that they own the very same asset when only one of them truly does. To wit, the IMF, the International Monetary Fund. We're not talking, blogs here. We're talking the IMF. As estimated, the same collateral was reused 2.2 times in 2018, which means both the original owner plus 2.2 subsequent reusers believe they own the same collateral. That's why US Treasuries aren't risk-free. They're the most rehypothecated asset in financial markets. Let me say that again. We talk about rehypothecation in the precious metals markets. US Treasuries are the most rehypothecated asset in financial markets, and they're considered to be safe. Those of you in bond funds may want to get the hell out about right now. And the big banks know this, she says. And this, I'm a former auditor. Listen to this sentence out of her article. Auditors can't catch this because GAAP accounting standards obfuscate it, as I'll explain later. I'm going to let you read why, but this is key. Auditors can't catch it because the way that GAAP is set up. So anybody that believes if you do a legitimate audit per generally accepted accounting principles, that's what GAAP is. I know I'm a former auditor. Doesn't mean a hill of beans if the GAAP standards don't allow you to catch this kind of garbage. So even if you have an audit, it's not necessarily a good thing. And I can attest to that as a former auditor. I'm going to do a video coming up on the problems with audits. And it's going to blow your mind because it's going to come from an insider. It's going to blow your mind. But this statement should freak everybody out right now. Even if something's audited according to GAAP standards, it doesn't mean you're seeing the true risk. That's the plain English version of what she is saying. What it all means that is while each bank's financial statements show the bank is solvent, the financial system as a whole isn't. Ding, 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 ding. Why do we keep having problems in the repo market? Why can't we get proper liquidity in the market to meet Basel requirements? And they keep pushing it off and pushing it off. Because the financial statements lie. They say they're solvent and they're not. They can't get there. That's an artifact of this system. That's a consequence of this system. It's an inevitability of this system. It's how it works. This is how things go and crash. Okay. And no one really knows how much, and this astounds me, what she's admitting here that we're all, the system's screwed. This is back in 2019. No one really knows how much double, triple, quadruple, et cetera, counting US Treasuries takes place. US Treasuries are the core asset used by every financial institution to satisfy its capital and liquidity requirements. Basel III, Basel III, Basel III, Basel III, Basel III, Basel III. Liquidity requirements. Hello. Why did I make 4 videos about Basel III dating from December, I think, through January, February? 4. Why? This is why. Which means that no one really knows how big the hole is at a system-wide level, she says. This is the real reason the repo market periodically seizes up. It's akin to musical chairs. No one knows how many players will be without a chair until the music stops. Every player knows there aren't enough chairs. Everyone knows someone will eventually lose. Financial regulators can't publicly admit to this, but big banks know it's true. And that's why they hunker down and stop lending, what I said earlier in this presentation, when they sense one of their kin's in trouble. They recognize what appears to be an 8% risk-free arbitrage is anything but risk-free. That's why the repo market is seizing. They're shorting the treasuries, and nobody wants to take that garbage treasury as collateral. Because even if you get 8%, they don't care. It's not worth the risk, and the banks know it. And the regulators can't catch it, and auditors can't catch it because those systems aren't designed to catch this because of the lie, the fraud, which they call a fancy term, okay, $100 term, rehypothecation. Rehypothecation equals fraud. Derivative equals fraud. Okay, that's all you need to know. You don't have to be an expert in these markets. Rehypothecation, fraud. Derivative, fraud. Okay, treasuries, risk. They're not risk-free. You're going to go to mainstream sites and you're going to say, you need to put your money into a 401k fund concentrated on the bond market because it's never defaulted. Yeah, well, the repo market is seized up 3 times. And this system is a mess. And here it is on a mainstream site. She's telling you the problem. You still in those bond funds? You still feel safe? You may want to take a look. Okay, so there's a lot more into this. I mean, good gracious, she goes over how it works. To warn you, I'm just going to leave this up here. It's called The Real Story of the Repo Market Meltdown and What It Means for Bitcoin on Forbes. This is done September 25th, 2019. You have got to read this article. You have got to read this article. All right. On to, I talked earlier about the National Bureau of Economic Research. Remember when we had the mortgage meltdown, nobody was talking about the repo market. They went back in December of the following year and analyzed the repo market, 2 researchers, and this came out in NBR, December 2009. And they figured out what led off the financial crisis? The repo market. That's why I'm harping on the repo market and treasuries, which make up much of the liquidity in the repo market. Here the researchers say the loss of liquidity at the firms that were the biggest players in the securitized banking system led to the financial crisis. Okay, biggest players. Who plays the most in the treasury markets? The biggest players. Who is most in the repo markets? The biggest players. Okay, you get it? You're talking about systemic risk to the system. It's one thing from a small bank to fail and getting bailed out to one of the largest players, which have the most risk. If one of these bad boys goes down, chaos, and that's what we saw in 2007, 2008. The financial panic, I'm reading right here. The financial panic of 2007, 2008 stemmed from a run on the repurchase or repo market, the primary source of funds for the securitized banking system. Rather than a run on monetary deposits as in earlier banking panics, according to a recent study by Gary Gorton and Andrew Metrick. Repo is a form of banking in which firms and institutional investors deposit money by lending for interest short-term and receive collateral as a guarantee. The authors defined securitized banking as a creation of structured bonds from bank loans, such as mortgages, which are then often used as collateral for repo. See, the more you can't get away from mortgage in the financial system. What did I say on my last video was going to happen to mortgages as the default rates on credit cards, security loans, and autos went up? It was going to eventually make its way to mortgages at a time when you can't refinance because rates are going up. You can't save yourself by refinancing. Rates are going up. What's behind the repo market? Mortgages. You see the problem there. You see me linking the last video I did this week 2 days ago to the video I'm doing today. I'm starting to link these financial topics to you so you understand the systemic nature of risk in this system, and you cannot get away from it if you're in the system. Pay attention to this stuff. In securitized banking and run on the repo, that's their working paper, 15223, with a link here if you want to read it. They argue that securities created from loans that originated in the subprime mortgage market played a major role in inciting the event, but that ultimately it was a loss of liquidity in the firms that were the biggest players in the banking system that led to the financial crisis. I have now linked the repo crisis from 2009, the repo crisis from 2019, and the repo crisis from this past week together. It's all the same thing. It's not stopping. And the Fed keep having to throw money at it. Where's that chart of Fed contributions? Oh my gosh, it's in here somewhere. Here, excess reserves. They keep throwing more money at it. Even the excess reserves don't solve the issue. You can't. It's systemic. It's the framework has to fail. It's a framework set up to fail. I've said this over and over. If you go to the research section of my website, goldsilverpros.com, scroll all the way down to the bottom, hit the link to research. One of my predictions is that this system has to fail for these reasons. I've written articles on it. They're all linked there. You can check when I wrote and how I wrote and what I said. Well, guess what? I've been saying over the past 6 months that I flew out 2018 to Phoenix and visited Lynette Zhang of ITM Trading, very popular YouTube channel, over 100,000 subscribers. One of the first videos I did when I decided to move from writing into doing video work, or to adding video work to my repertoire. I really love Lynette Zhang because she's great at educating people on a lot of systemic risk. So I flew out on my own dime, nobody paid me for this, to go talk to Lynette. I predicted the repo crisis. Now, I didn't use the word repo, but I did say there was a liquidity issue in the system because there's more debt than there is cash. In other words, there's a liquidity issue. And I want to show you guys that video. I'm going to This was put on my channel December 18th, 2018, under Gold Silver Pros, talking major market risk, gold and silver with Lynette Zhang. She put it on her channel a couple months later to get it some more exposure. But this part, starting about 32.57, I start to talk about liquidity issues. And this is where I'm predicting what's going to happen the following September. Even though I don't use the terms repo, listen to what I say.
And a much scarier part.
Yeah, and I think it's the snake eating its own tail, because we go back to the beginning part of our conversation. We were talking about corporate debt. It's something I brought up. We only have about 1.6 trillion if you look at Fred, which is the Fed's website on monetary data.
My favorite site.
Yeah, I know
if you haven't been on there, you need to go.
So there's 1.6 trillion of available actual printed currency. There is over 3.4 trillion of foreign debt and U.S. denominated debt. Sorry, and then we have multiple trillions in the U.S. as well. So that's sort of creating this demand for the physical dollars to pay off that debt. And because they took on so much debt and blew up the system, they blew up the values of the stock market and the companies. Now that debt is starting to come due, it's starting to grab for those dollars. And I did a video just on this, and it's creating what I call a melt up, because the dollar relative to other currencies is being demanded more, so that index value goes up, even though the fundamentals of the dollar are actually coming down.
Exactly.
So if you just look at the dollar index, you look at that and say the dollar's better than every other currency.
Right.
We have a strong dollar, This is what Trump says, but what's really happening is it's being demanded so much that eventually it's not going to exist. And when you have a deflationary situation, they're going to have to bring out the helicopters and start printing, and that's where you're going to see the hyperinflation. And so, to add one more point to that, a lot of people say that we're heading into stagflation, much like Japan had for a couple.
All right, I'll stop the video there. We get in talking about Japan and how this time will be a little bit different, because what's happening in Japan is happening to the rest of the world. But you can see there in that video, I'm talking about liquidity issues. I'm talking about how much debt there is in the system compared to money, and how we're going to have liquidity issues. And that's what happened in the repo market 10 months later. Now, it happened a little bit differently than I said it would, but it basically was the same thing. The short-term liquidity, the overnight lending, liquidity in the system started to freeze up. The difference is between 2019 and now. 2019, there wasn't enough liquidity in the system, so the Fed had to pump it in there. Now it's a confidence event. That's why I think it's unstoppable this time. What do we talk about when you have a failure of the currency? We talk about a confidence event, okay? We talk about people lose confidence in things, and when you lose confidence in paper things that aren't backed by like gold or something of value, it's a derivative, they crash. What's happened to all fiat currencies in history? They crash, okay? What's happening to the bond market? People are shorting it. They've lost confidence in the standard bearer of the strongest bond ever in existence in the world history. And nobody wants it. They're shorting it, and it's causing a seize up of the system. And you're seeing it manifest in repo. It's getting worse, not better. Worse, not better. Now, something more interesting I want to show you as well. I think we're getting closer to the financial chaos. And if you remember back, I'm not a political channel, so I don't want to get political here, but if you remember back to January and you saw the issues with the people at the Washington, D.C., at the Capitol, and you saw the issues of people breaking into some buildings, whoever you want to attribute that to, and then all of a sudden they started putting a razor wire, around the buildings in Washington, D.C. And the FBI, sometime around January 12th or something, it came out in reports that the FBI had said ahead of time that there could be some domestic terrorist type activities, meaning residents in the United States could act and be violent, and then it was ignored. So the people took that to heart, the government took that to heart, and now there's some lockdown procedures. You can see the lockdown in Washington, D.C. Well, I happen to have been traveling lately, very recently, and it was in Richmond, Virginia, home to the Virginia State Capitol. And I'm going to show you a video of what I saw there. And why this is important is because it's 2 months ago we had, the issue relating to the election. I haven't seen anything major since. I haven't seen anybody rushing any buildings or anything like that. So 2 months later, they're basically securing Virginia State Capitol in Richmond as if something else is going to happen. I think we're comfortably 2 months past that prior incident. And we're not in Washington, D.C. This video is not shot in Washington, D.C. It's about an hour and a half away, about 90, 100 miles away. But they're arming it as though they're expecting an insurrection. So I'm going to show you this video. I'm going to come back and make a couple of comments. Be right back. So here we are in Richmond, Virginia, looking at the Capitol complex, and it's gone on lockdown. As you can see, they don't want pedestrians going up the steps. They have the cones, and then there is heavy-duty chain link fence around the building. They say it's for construction when you walk into the square. I don't see a whole lot of construction going on. To me, I think they just don't want people basically storming it like they did the national Capitol. And so they're basically fencing it off. And this is, you can tell this is the high quality chain link. It's the black reinforced. It has bars going across at the midway point. I don't know if you guys can see that. This is heavier duty chain link, meant to stand for a while because it's painted black. Meant not to be torn down. That's why it's got the grid pattern of thicker poles with the chain link tied to it. It's meant to withstand people pulling it down by force or trying to bum rush it and knock it over. It's the reinforced chain link. I'm going to show you where some construction workers are actually installing chain link around a little square area here over by that statue right there. You can see the guy on the horse in the background. I'm going to walk over there next and show you them installing that. Okay, here we are at the site of the statues here in Richmond. And you can see they're installing the fence around it, chain link fence around this little square. See the construction workers on my left and on my right over here as well. And it's got statues of Patrick Henry and some other people here as well. Part of the overall history of the state of Virginia. Of course, you can hear the construction going on in the background, the cranes going on in the background, some building of some new sky rises here in Richmond. But they've got the chain link going up around this. Now you notice this is a different chain link. This one doesn't have the bars in the middle for reinforcement. It's a common everyday chain link you'll see around construction sites. Normal chain link. It's not reinforced at the bottom and the middle with these bars. So I don't think this is as much designed to stop a bum rush of people as this, maybe just to keep people off from potentially knocking down a statue or spray painting it. And maybe also for some renovations, although if you look at this, it looks fairly new. I'm not sure the history of this monument and the statues, but they're very expensive, as you can tell. Large statues, and it's not cheap, but it looks fairly new to me. Relatively speaking, it's not 200 years old, in other words. So I'm not sure how much construction they need to be doing. In any case, this is what's going on. I'm going to back up so you can get a wider shot. Okay, I'm out here in Richmond past the memorial, or dedication I should say, to women's suffrage right behind me. And you can see where they've got an extra layer of fencing here. Now this is construction fencing. It's not the super reinforced, although it does have, it's fairly stout. But this is blocking access from the street. And there's two layers of it. You can see beyond this chain link, there's another layer of chain link out street level. So they're blocking the street level with some heavier black chain link. And then there's a row of lighter chain link on the road, and then a row right here in front of me that you're seeing predominant on the screen. Let me go above and you can see the other. That's that second layer chain link. And on your left, right there at the street crossing, there's the heavier black reinforced. That's more crowd control, that black stuff, because it's got the middle crossbar going across, and the bottom is also reinforced. If you look at this chain link, it doesn't have the middle crossbar, it's just bottom reinforced, but it's designed to keep people from crawling under or going through. And you can see on the outside there is about a 5 foot or so black wrought iron fence, fleur-de-lis pattern on the top, which is reasonably protective against people getting onto the property But you can see here at the street level where all this comes together, where a lot of people could, for example, march on the complex. They've now got 3 layers of fencing in some places. And again, they're saying it's all for construction, but this is just a little wooded area. Not sure what construction they're going to do there. Can't plant too many flowers, you got a bunch of trees. They did cut down a tree over here, but I mean, this is all behind that outer fence anyway. It's not a danger to the public. So again, I don't think this is just for construction. That's just my thoughts, but you can see now the construction workers here right in front of me are tying together this fence that I showed you in an earlier clip together with the existing fence, and it's got a double, in some places a triple barrier. And I don't know if you guys can see it, but out beyond these 2 layers of chain link fence out there at the street before that first building in front of you is again the wrought iron fence. So it's got that wrought iron fence all around the complex. At the street corner where people could actually walk, they've got the reinforced black chain link, taller, looks like an 8-foot chain link, reinforced with a middle bar, and then they've got 2 layers of regular chain link. So right here at the front of the complex, they're really putting up a lot, and it's not just for construction. I mean, all of the construction workers out here are putting up fence, they're not doing anything else. As we hear the bell tower here on our left. So they're not doing massive construction to the complex, at least yet. This all looks like crowd control to me, and all the construction people here are putting in fences. So here we're approaching the official visitor entrance to the complex, and you can see all the bollards on the street, these white things, designed to keep vehicle traffic off of the complex from the street. So you can't really drive up from Main Street to here because of the bollards. And they do have some construction going on to my left. There's a bunch of metal and things. I don't know what construction that is, but I'm going to show you this really cool. Here are the other bollards. The original bollards that were installed, these green ones, they've added the white ones since. And here's the official visitor entrance, which it seems like they got closed off, and they got a lot of construction materials here. I'm not sure what for. But that's the official visitor's entrance, which is probably closed, I would imagine. I don't see any other visitors other than me on the property. They are allowing me to walk on the property, but I think official visitor hours are over. But they've also got these bollards going down to the next street, so they're preventing people from driving a vehicle up, other than a construction vehicle, up the street to park right in front of the complex. You're not going to get there. These bollards are going to prevent you, and they're strategically placed everywhere so that you can't just drive up. And again, all the construction workers I'm showing you right now are installing defensive systems. They're not rehabbing the facility or the complex, at least not right at this moment. And again, to confirm where I am, I'm going to walk up to the sign here on the front and show you that I'm at the Virginia State Capitol. Bank Street entrance, 1000 Bank Street. These are the original bollards, the green ones. And you can see that they've installed these white ones on the street level. And going down this way, you can see that they've got construction and bollards over there. And then of course they have the normal fence with the fleur-de-lis at the top, or basically equivalent of the fleur-de-lis. It's that pointy thing at the top. This is your normal crowd control, and then they've got some additional crowd control fencing that you see, you know, at amusement parks and when you have any sort of big social gathering, the normal crowd control stuff. So it's all this crowd control stuff is here. Of course, you see this big vehicle gate system made by Nasatka Security, and they can lower this gate and it will allow traffic in and out. And if they raise the gate, you can't get through. So enhanced security here at the Virginia State Capitol. And I want to show you the sign, the Virginia construction areas here at the state capitol. This is the official sign that they put up, and they're showing the construction areas. All that red stuff is basically the fencing, the construction fence. So you can see they've fenced the north end. They're fencing down to the capitol. They've got the enhanced fencing. This is the black fencing I was showing you earlier around the front. The black goes here, and then we've got 2 to 3 layers back behind the capitol of the lighter fencing. That's how they're protecting it. Supposedly during construction, although I'm on site and I don't see any construction, whether or not they're going to do any in the future, I don't know. But it's not just construction, because if you're doing construction, do you put all these bollards on the street? I count at least 30 bollards along this frontage street to the Capitol, the official visitor side. And they don't have the bollards on the other street, but they do have this black fencing that would prevent you from from driving up to the backside of the Capitol complex, and 2, in some cases 3 layers of the regular fencing or the enhanced fencing. The only construction I actually see in construction equipment is across the street. This is one backhoe that they have here, and they've got some obvious construction going on at the building across the street. Whether they're going to do some in the actual Capitol, I don't know, but at this particular time, there's no actual construction going on the Capitol Street other than the fencing. And it's like they're fencing the whole complex per the sign I just showed you before they do anything, but I don't see any actual construction. So in any case, this is what we got. More crowd control fencing here along the walk leading down to Main Street. So I don't see anybody lining up to go into the Virginia State Capitol. It's probably closed. I don't know. I haven't looked at the website, but just wanted to show you the reinforcements that they have right now. And all of the current construction is off of the Capitol. It's on this building across the street. What they're doing, I have no idea. They got some of the ground torn up around the Capitol, so they're probably doing some sort of waterworks or electrical or something. Who knows? Anyway, that's it. That's my visit to the Virginia State Capitol. Okay, so we're back from the video. A couple of comments I want to make there. The only construction going on were buildings not at the Capitol complex. There was a courthouse, which I showed you at the end of that video, which had some stuff going on. Nothing at the Capitol complex that I could tell. Nothing at the statue, the really nice statues, bronze statues they had behind the Capitol or behind the administrative buildings. And there was some construction of some high rises behind it, but nothing on the Capitol complex. And the fencing they're putting there is not construction fencing. It's layered security fencing. And the other thing you have to consider is there is a wrought iron fence all the way around the complex. All I gotta do is close the fences, and you're gonna be okay from a construction standpoint. There's cranes in there and everything. People aren't gonna be in danger. But the bollards that they put, the fencing that they put is a sign that they're locking down the Capitol, because I think they expect something to happen. And it could be stuff like this, the repo market and locking up of the economy. If you have another crisis of the financial system, and you add that to all of the divisiveness that occurred during the last election, you could potentially have a short-term bowling over point. And potentially that's what they're preparing for. But I was kind of so shocked by it. I was just here, had no idea this is going on, just wanted to go visit. It's a historic part of our country. I always try to see like historic things if I'm on a trip, just grab, go to San Antonio, see the Alamo, whatever the case may be. Last time I was in Washington, D.C., I went and saw, the National Mall and all that kind of stuff. So I just try to do that. And I was kind of shocked by what happened. So they're preparing for an emergency. Is it going to be the repo market and this occurring? Is going to be something else? I don't know. But it's obvious that the government's worried. And it's obvious that they're worried about people protesting and having a reason to protest. What would be a reason to protest? The election's over. It's going to be something else. It's going to be another catalyst. Maybe this is catalyst. I don't know. Anyway, I just want to share that with you guys. This is going to wrap up the video for today. This is Rob Keens of goldsilverpros.com.